What if the government doesn't treat everyone the same? And I mean, not because of who you are or where you live or what you believe, but strictly because of how you earn your money and how much you already own. Kind of provocative, right?
Welcome to This Explainer. Today, we're unpacking a fascinating, absolutely crucial concept, the wealth ladder. We're going to literally trace a single dollar as it moves from a teenager's very first paycheck all the way up to a staggering fortune passed down through generations. Our core thesis today is simple, but it might just change how you see the entire economy. Tax rules completely shift based on how you earn, not who you are.
Okay, let's dive right into this. Here's our roadmap for today. 1. The shifting tax rules. 2. Taxing labor and salaries. 3. The shift to ownership. 4. Extreme wealth and death. And finally, 5. Navigating the ladder. Section 1. The shifting tax rules. Not who you are, but how you earn. The most important thing to establish right off the bat is that this isn't some, grand secret conspiracy. It's deliberate policy. It's written into thousands of pages of tax code passed by Congress and adjusted every single year by the IRS. The rules are right there out in the open. Most of us just never actually read them. Moving right along to Section 2, taxing labor and salaries, from the first paycheck to the salary ceiling. We're going to examine the first 4 rungs of our ladder here, which really represent the traditional labor side of the whole equation. So rung 1 is the standard paycheck. For most working Americans, the federal income tax system is progressive, broken up into 7 brackets, ranging from 10 to 37%. Think of it literally like filling up a row of buckets. Your first dollars fill up the lightly taxed buckets, and each additional dollar you earn spills over into higher tax buckets. This is your marginal rate, the tax paid on your next dollar of income. Now, it's definitely worth noting that your effective rate, what actually leaves your paycheck at the end of the day, is almost always lower than people assume, since it averages all those buckets out together. But, well, income tax is only just part of the story. Take the number 176,000. You pay 6.2% for Social Security and 1.45% for Medicare directly out of your paycheck. But here's what most people completely miss, that 6.2% Social Security tax completely stops being collected once your income crosses a specific wage cap. That threshold rises annually and currently sits right above $176,000. Earn below that, and every dollar is taxed. Earn way more than that, and only that first slice is taxed. It's actually one of the only major U.S. taxes that becomes a smaller share of your income the more you make. Crazy, right? Moving up to rung 2, we find a really strange trap for the working poor. Did you know that picking up extra shifts can actually penalize you? Seriously, the government offers the earned income tax credit to reward work. But as you earn more, this credit grows, then plateaus, and then rapidly shrinks. That shrinking phase creates what economists call a hidden marginal rate. For every extra dollar earned in this zone, a low-income parent can lose over 20 cents of their credit, right on top of the taxes they're already paying. So by simply trying to get ahead, they can face a steeper effective tax penalty on that next dollar than someone earning 10 times their salary. Make it make sense. On rung 3, we hit the middle class. The government hands you tools to defer taxes for retirement, things like 401ks and IRAs, and the contribution limits look totally fantastic on paper. But here is the massive catch. These accounts only work if you actually have money left over at the end of the month to fund them. For families living paycheck to paycheck, this massive tax advantage is a rule that exists entirely in theory, but literally never touches their day-to-day lives. Let's move up to rung 4 and see how this builds for high-income earners, your doctors, your lawyers, your senior engineers. They hit a really odd ceiling. Because almost all of their income is strictly classified as ordinary labor, they face the highest marginal tax rates in the entire system, up to 37%. In this fascinating twist of the code, highly paid workers are taxed more aggressively dollar for dollar than people who are much, much wealthier, but who earn their money without ever clocking in. Which brings us perfectly to Section 3, the shift to ownership, when money works for you. This is where the rules of the ladder completely change. Now, what's really interesting about this contrast is what happens on rung 5. We meet the investor. Like we just talked about, high-income salaries are taxed up to 37%. But if you sell a stock you've held for over a year, that profit is a long-term capital gain, taxed at just 0, 15, or 20%. The system legally and deliberately taxes ownership far, far more gently than labor. This is one of the biggest forks in the entire U.S. tax system, built on the economic theory that lower rates encourage long-term investment. Step up to rung 6, the business owner, and entirely new levers suddenly appear. The tax code actively rewards risk-taking. For instance, there's a 20% deduction for many pass-through businesses. This literally allows owners to legally shield a fifth of their income from being taxed entirely. Then there's depreciation, letting businesses write off the cost of property and equipment, sometimes even faster than the asset actually loses value. It's almost like financial magic. But again, you have to actually own the asset to play the game. On rung 7, the multimillionaire level, we find obscure but completely legal workarounds like the mega backdoor Roth. This essentially allows incredibly high earners to funnel tens of thousands of after-tax dollars into accounts that will then grow tax-free for the rest of their lives. It's not hidden, but structurally, it requires a specific employer plan and immense spare income to max out standard contributions first. By design, it's just out of reach for the vast majority of workers simply because they don't have the spare cash flow lying around.
Section 4. Extreme wealth and death, unrealized gains, and the final transfer. Here, we explore the untouchable, highest rungs of the ladder.
Rung 8 is the billionaire class. Extreme wealth in America isn't sitting in checking accounts, it's unrealized value in stock. The strategy at this level is wild. Step 1, hold appreciating stock. Step 2, instead of selling it and triggering a massive tax bill, you just borrow money against that stock to fund your yachts and lifestyle. Step 3, because loans aren't classified as income, you trigger zero income tax. It's not tax evasion, guys. Our system is explicitly built to tax realized income, not wealth that simply exists on paper. And then we reach the final rung. What happens at death? When assets pass to heirs, they receive a step up in basis. This is a crucial mechanism where the asset's value legally resets to the current market price on the very day of death. Just think about that for a second. It effectively erases decades of taxable gains. Heirs can sell that stock the very next day and owe absolutely zero capital gains tax on a lifetime of growth. Layer right on top of that, the federal estate tax exemption, which currently sits at a massive $15 million per person, or $30 million for a married couple. Because this threshold is astronomically high, fewer than 1 in 500 estates in America ever actually cross it to pay the estate tax. So the crucial point is, what does all this actually mean for you? Let's look at Section 5, Navigating the Ladder. What this means for you. According to Federal Reserve data tracked since 1989, there is a striking imbalance. The top 1% of American households currently hold roughly 32% of all household wealth, leaving the bottom 99% to share the remaining 68%. And honestly, the bottom half holds just a tiny, tiny sliver of that. This immense gap isn't just about who works harder or who went to the right school or who just got lucky. It is quietly, steadily, and legally shaped by which rung of this ladder your income and assets sit on. Now, an important clarification here to keep things balanced. The honest picture isn't a simple villain story. The wealthy do pay a massive total amount of taxes. As we saw, higher earners on a salary face the steepest marginal rates. The estate tax is highly progressive when it actually applies to those rare massive fortunes. And most billionaires did build companies that created immense economic value. Our goal with this explainer is simply to objectively point out that the system heavily prioritizes the type of income you have over the raw amount. So what can you actually do with this information? Well, you can't personally rewrite the tax code, but you can definitely build your financial literacy. If you can, maximize your tax advantage retirement accounts. If you invest, try holding those assets past a year to unlock those much lower capital gains rates. Most importantly, deeply understand how your own income is classified. These are actionable levers available to far more people than realize it, simply by knowing the rules actually exist. I want to leave you with this final thought from our source material. The people who build lasting wealth rarely do it by earning the most. They do it by understanding, earlier than everyone else, exactly how the ladder works and which rung rewards ownership over labor, patience over speed, and knowledge over luck. So, I have to ask you, after seeing how this system truly operates, what rung of the ladder are you currently standing on? And what steps are you going to take tomorrow to start climbing? Thank you so much for joining me for this explainer.